Welcome to the webinar. My name is Dave Pramer. I'm a director in the Yale School of Management within the executive programs. And this webinar is going to be discussing our partnership with EDHEC, and it's basically discussing the Risk Management Advisory course. It's an advanced course. The session outline today is going to be a very brief introduction, and then I have here with me Professor Lionel Martellini. He's going to be then sharing basically discussion on the investment management industry transformation, and then also providing an overview of the overall certificate program. And then I will close by giving a little bit of information regarding the feedback we've received to date on the program itself and some local details. Let me start now with Professor Martellini.
Okay. Hi, everyone. Let's talk a little bit about what's taking place in this investment industry. It's actually fair to say that, we are looking at a few interesting changes. For many years, not much has happened. If you think about we think about the big paradigm changes, like development of passive money management. I think that took place, around the 80s. I guess Vanguard was founded in 75 or so. And then in the 90s, we've seen, open architecture and multi-management, fund of funds and multi-manager type of solutions. But these were mild evolutions. We actually have reasons to believe that the true industrial revolution has started in investment management. And now, as we speak, there are very profound changes that are currently taking place. One way to think about these changes is to think about the three main dimensions in which they impact our industry. The first dimension is mass production. As always, an industrial revolution starts with mass production. Now, I'm talking about smart beta here. So what's happening is mass production has taken place a long time ago in investment management with the mutual fund industry. Well, the mutual fund industry is all about mass production. But we've been mass producing kind of expensive underlying portfolios. Now with the smart beta, you get inexpensive access to fairly efficient harvesting of risk premium. So that's a big change, and that's really inexpensive. So it's mass production of meaningful underlying building blocks that actually are fairly cheap to buy from the client perspective. Well, that's the mass production, and then there's mass customization, which is the other key dimension in any industrial revolution. Now, mass customization, it's all about investment solutions as opposed to investment products. I'll come back to this point, which is very important in just a minute. And the last one is mass distribution. Now, by mass distribution, if we turn to individual wealth management, what we are looking at as we speak is this digital disruption. So we get all the robo-advisors that would allow you eventually to use your iPhone, your iPad, come up with your own goals and needs and balance sheets, and eventually get access to some kind of customized or mass customized piece of advice in terms of how to run the money. So the bottom line is mass production, mass customization, mass distribution, all of the pieces of the puzzle are currently now fitting into place. And things are happening very, very fast. So the reason why we started the program, which is a joint program between Yale School of Management and the EDHEC-RISK Institute, is because we wanted to share with you our best insights in terms of how to get prepared today for what's going to come ahead in the investment management arena. Also, let's flip next slide and let's see a little bit more about
Before I go there, one more note too. If you have a question, there's actually a question button on your slide on your screen. Just click the question button. It'll drop down. You can then type a question in for the audience, right, either private or public, all right? And then I'll ask Lionel the question, and then we'll also answer the questions that go along here. Okay, Lionel, sorry.
Okay, sure. So remember we said key mass customization was an important part of this industrial revolution that's impacting our industry. Well, mass customization is all about, providing investors, asset owners, whether they are individuals or institutional asset owners, providing them with meaningful investment solutions, as opposed to off-the-shelf investment products. And, that's what I call stating the obvious, right? Investors are facing specific problems and they don't need, products. They need investment solutions. They need dedicated investment solutions. The point I'm making is having a very profound impact on the investment management industry and on the way money is being managed for institutional clients and also individual clients. It's a whole new investment paradigm that's actually taking place, before our eyes. This new investment paradigm actually has a given name. We call it liability-driven investing for institutional investors. Now, it's clear that an institutional investor problem is typically very complex. If you think about a pension plan, for example, it's typically very complex, but most of that complexity can be summarized in terms of their liabilities. So eventually they have to pay those pension liabilities. And what makes it tricky is that they have to pay those pension liabilities in the presence of pretty tight dollar and risk budgets. So in other words, they are not necessarily overfunded. More often than not, they tend to be underfunded. And also they have very limited possibility for, taking risks. In other words, they have minimum funding ratio constraints or very specific target on volatility of the funding ratio or volatility of the contribution. Well, this is what makes the pension fund problem kind of very complex and not an easy challenge. In the same way, if you turn to individual investors, well, that's pretty much the same problem. We tend to call that goal-based investing as opposed to liability-driven investing, just because we recognize that individuals don't exactly have liabilities. What they have instead is they have goals. Consumption goals, retirement goals, all kinds of goals, and different goals at different points in their life cycle. And so what these investors need, they need to get the highest probabilities to achieve those goals. And themselves, they're also facing, pretty tight dollar and risk budgets. So they have max drawdown constraints and they've got limited contribution power, right? So in the end, what we're saying is, individual and institutional investors alike, they are facing, very, very complex problems. And investment management as an industry should obviously be all about maximizing the probabilities for these investors to, meet their objectives. Okay, so let's move on to the next slide. Thanks, Dave. So the point I'm making is, of course, hardly new. There's this very interesting quote by Bob Merton, who is a Nobel Prize winner in economics for his work, option pricing, but also, more importantly, perhaps, on portfolio selection. And here is what he said in a paper published in the Financial Analyst Journal in 2003. What he says is precisely that it's not new to say that optimal investment policy should not be one size fits all. In other words, we need dedicated investment solutions. We don't need, products that are good for everyone, meaning probably that they are good for no one. So we need, dedicated investment, solutions. In practice, however, there is much more uniformity in advice than is necessary. Investment managers and advisors have a much richer set of tools available to them than they traditionally use. I see this issue as a tough engineering problem, not of new science. We know how to approach it in principle, and actually doing it is the challenge. Well, I came up with this quote because that's a pretty good summary of what the whole, program is all about. The whole program is intended to help investment professionals comes to grasp with the challenge of actually implementing meaningful investment solutions and trying to, help them meet the needs of their clients. So if we move on to the next slide, we definitely know how to approach it in principle. In principle, we understand what it means to perform investment management in such a way that we can help, investors spend their dollar and risk budgets, but in a smart way. We want them to spend $1 in risk budget in a way that's going to lead them to, meet their goals or liabilities with the highest probabilities. So what we need to accomplish is actually pretty clear. How to accomplish it in principle, at least in principle, is also very clear. So there are actually very few basic requirements for an investment solution to be meaningful for a given investor. It can be summarized as follows. We need a good safe building block, we need a good risky building block, and we need a good allocation to the two building blocks, the safe and the risky. That sounds pretty straightforward. Well, that's precisely what the program is all about, trying to provide participants with a pretty good understanding, not only at the conceptual level, but also at the implementation level, of what it takes to design and to implement a good safe building block, a good risky building block, and a good allocation to the building blocks. Now, from the conceptual perspective, there is now a very good understanding that this is achieved through a proper use of three known forms of risk management: diversification, hedging, and insurance. It all go with these three forms of risk management. So first of all, when we want the risky building block to be a good risky building block, what do we mean? Well, a risky building block is good and meaningful if it is well rewarded, right? Because after all, we don't enjoy, as investors, taking on risk just for the sake of taking on risk. The reason why we are willing and prepared to take on risk is because we hope to get a reward for that. Well, precisely, diversification is the risk management technique which, if properly used, and there's lots of subtleties involved in the properly used, but if properly used, will allow us to harvest risk premia across and within asset classes in the most efficient way. It's all about diversification for designing that risky building block in such a way that it enjoys the highest possible reward per unit of risk. But the next form of risk management is hedging. Why is hedging useful? Well, because remember, we said that we needed a safe building block. Well, so what is a good safe building block? Well, a good safe building block is a building block that's truly safe. So we want to be efficient at not taking risk, if and when we come to times and situations and scenarios and market conditions under which it is preferable for us not to take risk. In this case, we want to avoid taking risk. Now, it turns out that avoiding taking risk is not as simple as not investing in the market, because of course risk is defined relative to our liabilities or to our goals. So we want to think carefully in terms of what it means to design and, more importantly, implement meaningful liability hedging portfolios and also goal hedging portfolios. Okay, good. Once we come to peace with how to implement a good risky portfolio through diversification and a good safe portfolio through hedging, the next challenge is how much to be allocated to risky versus safe. And something that has become painfully clear over the last, few years is that there's no magic number there. It's not like it should be 50-50 or 80-20 or 20-80. We now fully understand that the allocation to the risky versus safe should react to changes in different things, to react to changes in market conditions. As we move across the business cycles and volatility goes up and down and risk premia go up and down, we should of course adjust the allocation to risky versus safe. And everything else equal, it should also react to changes in dollar and risk budgets. So if I'm getting really close to my minimum funding ratio, or if I'm about to outspend my maximum, drawdown risk budget, then, I need to take actions to make sure that I'm, keeping track of these dollar and risk budgets the way they should be properly managed. So to make a long story short, we've got to understand how to use diversification, hedging, and insurance in a holistic framework that should allow us to, design these meaningful investment solutions. Well, if we move on now to the next slide, well, then, it's actually giving us a flavor not only of what the next seminar is going to be all about, seminar number 1, multi-asset investment products and solutions, but also what the subsequent seminar, seminar number 2 and seminar number 3 will be all about. Well, so it's all about actually doing it, right? So we have designs, Will Gottsman from Yale School of Management and myself have sit down and designed this curriculum and this program in such a way that we are trying to provide participants with the most useful insights possible in terms of how to actually doing it. So the first seminar, which is called Multi-Asset Investment Products and Solutions, is all about day number 1, which I will be teaching, is all about harvesting risk premium across asset classes. It's a multi-asset context. Now that's kind of useful because that allows us to make sense about how to design multi-asset products. Now, then, day number 2, we're going to start jumping into LDI and GBI, liability-driven investing and goal-based investing. So that's moving away from, okay, we have been able to design meaningful investment products, multi-asset. Now we want to actually move into meaningful investment solutions, taking into account, the liabilities and the goals of the institutional or individual clients. So we're going to talk about things like, improved forms of target date funds, improved forms of retirement solutions, managing assets from a defined benefit pension plan perspective or from a defined contribution pension plan perspective. How do we manage portfolios while keeping track of the goals and the liabilities? Now, on day number 3, my colleague James Choi from Yale School of Management is going to talk about, how to spice up, the attractiveness of these investment products and solutions by using predictability in asset class and asset manager returns. So if you will, James Choi is going to talk about the icing on the cake. So hopefully, day number 1, day number 2, we will be discussing how to bake a tasteful cake that will do good, portfolio doing a good job at addressing the needs of our clients. And then on day number 3, James Choi is going to say, well, but there is evidence of predictability in asset class and asset manager returns. So if I move away from pure beta management and add the benefits of predictability, how can I improve those multi-asset investment products and solutions by trying and add the timing component, both in terms of asset classes and in terms of how I'm implementing this portfolio decision with asset managers. So that's seminar number 1.
Lionel, just to interrupt a second, I'm sorry. There's a question here regarding any things in terms of what's the combination of advanced research and also practical solutions, and are there any things left behind that I take away with me after a seminar?
Yes, it's a good question. What we've decided to do, we've actually developed portfolio construction tools that are Excel-based. They are meant to be used, in an educational context. So they are not like professional system for managing money. They are designed to help foster the understanding. So what I will be able to do, especially on day 2, I will be able to provide a set of Excel-based dedicated tools that can be used to design welfare improving forms of investment products and solutions, like improved forms of target date funds or improved forms of retirement solutions. So yeah, we're going to try and not only leave the participants with a conceptual understanding of the challenges involved, but also on some kind of tool helping them nail down in terms of design and implementation what those investment solutions could look like.
And the question in terms of advanced research versus like existing well understood material, what's the combination of that?
Okay. Yes, sure. So what we'll do is most of the seminar is actually triggered and intended towards meaningful insight from advanced research. So anything that's extremely simple, basic understanding of portfolio theory is more or less assumed to be understood by participants. And experience has shown that most participants actually have a pretty good understanding of the most basic material. So we're trying to, go pretty fast on the most basic material, contextualize it, and then move on to, what makes sense. So for example, if I talk about the multi-asset investment product, for example, I'm not necessarily going to talk about mean variance analysis applied to building these products, because we all know that mean variance analysis is hardly usable in practice. I'm more going to be talking about things like risk parity, factor risk parity, which are, the techniques that go a little beyond mean variance analysis, and are actually implemented in real world, practice in terms of, manufacturing those products. And what I'm going to try and be doing is providing academic insights in terms of what are the limitations and benefits of these advanced techniques, and what are the things that, investors and managers should be mindful of when using those techniques. Okay, so the focus is not necessarily sophisticated quantitative techniques in terms of high-level math that's not understandable by, by normal people, but it is advanced academic-based, if you will, practical insights that can be used to make a difference in terms of portfolio performance. Now, seminar number 2 and seminar number 3, which also share the same focus, which is away from esoteric, pure scholastic academic research, but into kind of latest insights from the most useful part of academic research that can be used for, in the context of harvesting risk premium. So what we're going to do is, seminar number 1 is a multi-asset kind of context. Now, seminar number 2 is going to get into the most important markets, which are equity and bond markets. These are the traditional markets. And for 2 days, my colleague Ramanupal from EDHEC-RISK Institute is going to talk about advances in equity portfolio construction. And Will Gottsman from Yale School of Management is going to talk about smart beta and factor investing in the equity space, which has become, if you will, an important, very significant development in investment practice. And it's one of these developments where we feel that academic guidance can be useful, because we're kind of sometimes lost in the fact zoo and many factors and many different smart betas and many different ways to use them. So Will is going to provide us with a little bit of academic framework to try and understand how to make sense of all of these initiatives. Now, last but not least, on day number 3, my colleague Ricardo Rebonato from EDHEC-RISK Institute is going to talk about harvesting risk premium in bond markets. Now that is very important. He's going to share with you the latest insights in terms of smart beta for fixed income portfolios. So Ricardo, before joining EDHEC-RISK Institute, was head of research at PIMCO. He has years and years of accumulated experience in terms of managing bond portfolios. And the main focus of his work and his attention today is precisely harvesting risk premium, interest rate and credit risk premium in the most effective way in fixed income markets. And we all understand that this is kind of new frontiers. That's probably, smart beta is by now fairly well understood in equity markets, but smart beta in the fixed income space is a real important challenge. That's going to be the next important development in this field. So that's about seminar number 2. Seminar number 3 is kind of expanding the scope in terms of investment vehicles and going a little beyond traditional asset classes like stocks and bonds, and leading to alternative risk premium. So harvesting alternative risk premium will be dealt with by 3 of our colleagues. So Will Gottsman will come back, and he's going to talk about the fundamentals of private equity, hedge funds, real estate, and fine arts. It's going to be a pretty nice, comprehensive introduction to how these alternatives are being used in the portfolio construction process. And Will is actually also going to use the example of the Yale endowment, which is, extremely famous for its kind of advanced use of alternatives in how they construct their portfolio. So that's going to be a first-hand account by Will of what's taking place in terms of how to fit these alternatives within the context of an overall portfolio. And then there will be a greater focus on 2 of these alternatives. So Gert Ruenhorst from Yale School of Management is going to talk about the fundamentals of commodity investing. Commodities is one of these very important asset classes for many reasons in terms of diversification benefits, also in terms of inflation hedging benefits. So Gert is going to talk about all of this and how to harvest risk premia. There are very specific risk premia in commodity markets, and there's definitely an art and science about how to harvest them. And the last day will be taught by my colleague Frédéric Blanc-Brun, who's heading EDHEC-RISK Infrastructure Research Center in Singapore, with the support of monetary authorities of Singapore. And he's going to talk about the fundamentals of infrastructure investing. So he has developed an extremely comprehensive database of infrastructure returns, and also a very comprehensive set of tools that can be used to analyze infrastructure deals and think about their impact in the portfolio construction context. So that's going to be the conclusion of the last seminar. Dave?
Okay. What this slide shows are the details in terms of when the seminars are being held. Essentially, each seminar stands on its own. So you could attend Seminar 1, which is held in March in London, March 7th through 9th in London, and March 21st through 23rd in New Haven at Yale. Then Seminar 2 is going to be held in London on June 21st through 23rd, and July 11th through 13th. And Seminar number 3 is being held in December 6th through 8th in London, and December 12th through 14th in New Haven. Now, the way the program is designed is that you can attend a seminar by itself, or else you can attend all 3 seminars and then also earn the certificate. And the certificate then is basically, looks like a diploma, but it's really a certificate that would be framed, and it has on it the combination of the Yale School of Management, signed by the Dean, and also the EDHEC-RISK Institute, signed by Professor Martellini. So it really is something that would be proudly displayed on your wall and kind of give you a chance to really demonstrate, so to speak, the credential you earn by attending these seminars here. The fees for this seminar are, for each seminar is basically $6,000 or euros, 5,000 euros, but there also are a variety of discounts available. If you want to go through a group discount, where it's groups of 5 or more, it's 10%, 10 or more, 20% discount. Alumni discounts, if you're alumni of Yale University or alumni of EDHEC, then there's a discount there. Then also there are various discounts for whether you're living local and you want to basically use your own home as opposed to a hotel, and then or dinner, and then also distance learning is an option too. So we accept kind of within this certificate program, attending one of the seminars remotely and still getting a certificate. So these are all the details around logistics that are part of this program. This slide here demonstrates some of the feedback we received from different attendees. And that the attendees are normally, they could be investment managers managing a portfolio, it could be private wealth managers, it could be product managers, those managers involved in designing new products for their institutions. It could be a state or federal government pension fund manager, could be a company pension fund manager that may be part of this. But essentially, what the feedback we're getting is that it's a combination of kind of thoughtful academic education, but still being very applicable to how you really kind of how you would be able to apply this in your day-to-day efforts and day-to-day endeavors. And then ultimately, it also is in line with many of the training programs. So we see a number of different organizations accepting kind of tuition reimbursement, so to speak, credits for this kind of thing, this kind of education. So it really is a combination of excellent academic credentials, but also very much a very sound kind of professional education in this space here. Who should attend the seminar? As I said earlier, the buy and sell side, it could be senior officers, investment specialists, and administrators. For high net worth, private wealth and institutional money managers, could be consultants, could be advisors, or could be account representatives. Finally, for additional information, you can reach out to either myself, David Pramer, at davidpramer@yale.edu. You also see my phone number here, or else Carolyn Prevost from EDHEC. And you see down here her email, Carolyn Prevost at edhec-risk.com, or else her phone number. Additionally, what's shown here are basically our websites. Okay, so it's really the Yale Executive Programs website, and it would be really looking up the program there would be the Advanced Risk Investment Management Program, or else it'd be the EDHEC website, and again, it would be the Certificate in Risk and Investment Management Program that's out there. In both cases, what you really press on would be the Enroll Now button to really enroll for the program. Any additional questions as we kind of wrap here? Here's a question that came to the table here. I'm someone looking to break into the risk management in my firm. I have 15 years experience. I'm a CFA charter holder. Is this seminar right for me, or is it too advanced? Lionel, why don't you answer that question?
No, I don't think there's anything as too advanced. If it is perceived as too advanced, it would mean that we would be failing to do our job properly. So in other words, what we're trying to do, the advanced thoughts component of the seminar is us trying to bring in what's most useful from academic research. And as everyone knows, I mean, well, many of us in academia writing lots of interesting papers, but most of that is essentially kind of for the sake of writing papers and not very useful. Now, some of the findings, though, are extremely useful for the practice. So what we're trying to do, so that's why we call it an advanced seminar. In other words, the content of the seminar is unfortunately not to be found in standard textbooks, okay? But the content of the seminar is the most useful kind of applied academic research when it comes to, smart beta in equity and bonds, when it comes to portfolio construction, when it comes to risk management, when it comes to investment solutions. So yeah, I definitely think it would certainly be suitable in this particular case.
Okay. The other note there too to add on to that would be that when these seminars essentially build up, I would say a quick overview of kind of historically where the investment thinking has come from, almost capital market theory has come from, all the way to kind of current thinking and advanced thinking in terms of how do you manage risk and how do you manage investments. So it does build up. It builds up quickly, but it does build up as you go through that process. So I do think that it also is a good refresher as you see the material, and then even the pre-reads kind of really help you kind of go through and get oriented in preparation for the sessions too.
Yeah.
Any more questions? Well, I want to thank you then for attending the webinar, and look forward to having you all attend, whether it be in New Haven or in London. I guess one more note too. Some people actually take seminars in both locations. So they may take seminar 1 in New Haven at Yale and seminar 2 in London and seminar 3 back at Yale, as a combination. And they do that often in order to kind of combine things. So sometimes they may combine that with a vacation, so to speak, in Europe, right, as they do this. So they're able to actually kind of take advantage of that time, and also the travel expense of flying over to actually enjoy some time over there too. So just another option too to consider as you kind of make your logistical plans. So thank you. This seminar is coming to a close.
Thank you. Bye.